Everybody talks about trading discipline, right? But what does that actually look like in practice? We're not talking about some vague theory today. We're going to break down one trader's personal blueprint, a real concrete set of rules they built to bring some order to all that market chaos.
So let me ask you something. What if the real secret to consistent trading wasn't finding the next hot stock tip, but just a checklist? Seriously, a non-negotiable list of rules that guides your every single move. It's all about switching from emotional reactions to a proactive process.
And that's exactly what we're looking at here. Now, to be super clear, this is not financial advice. Think of this as a case study in how to build a system. So let's dive right into this trader's process and really see the thinking behind each and every rule.
Okay, so where does all this discipline even begin? You might think it's when the market opens, but nope, the whole thing kicks off hours before that. The first part of this blueprint is all about preparation, making sure you are absolutely ready before a single trade is even possible.
The pre-market routine really comes down to 3 key steps. First up, you build a watch list of stocks that already have some momentum. Second, you identify specific technical patterns. This trader looks for things like flags, which are basically a stock taking a quick breather in a strong trend, and pivots, which are those key turning points. And third, you filter out any low liquidity stocks. This is huge, because if you can't get in and out of a position easily, it's a no-go from the start.
And this trader has a very clear favorite when it comes to patterns. It's something called tight action. This is when a stock's price is just consolidating, coiling up in a really narrow range. We're talking just 3 to 4%. You can almost picture it like a coiled spring, just building up all that energy for what could be a really powerful move.
All right, so your watch list is set, the market is officially open. Now comes the hard part, right? Execution. This next section lays out the super strict rules for when to pull the trigger, and, just as importantly, when not to.
Now this might be the most important rule of engagement, and it's just one number, 5%. The rule is dead simple. If a stock has already jumped more than 5% from its ideal entry point, you don't chase it. You miss the trade. That's it. It's a hard stop designed to prevent you from buying at the top out of pure emotion.
And this slide really gets to the heart of why that 5% rule even exists. It's all about forcing a disciplined entry based on your plan, instead of an emotional one, driven by FOMO, the fear of missing out. The system is basically your defense against those impulsive decisions that so often end in disaster. Okay, so if an entry is valid, the next step is just pure financial discipline. Position size isn't a guess, it's a calculation. The amount of money you're putting at risk and the exact level of your stop loss are all figured out before the trade is ever placed. There is zero improvising here.
So you're in the trade. Now what? Getting in is only half the battle. This next set of rules is just as critical. It's all about managing the position and knowing exactly how and when you're supposed to get out.
This trader uses a really specific, tiered exit strategy. The first third of the position gets sold if the price drops to the 10-day moving average. That's often a sign of weakening momentum. Another third comes off at the 20-day moving average, a longer-term level. The final third, though, that's left to run, aiming for a huge win, to find is 4 times the initial amount risked. It's a really mechanical way to lock in gains while still shooting for that home run.
This rule right here is the psychological anchor for that whole exit plan. It's a reminder. Once the system is in motion, don't mess with it. If the criteria for selling haven't been met, you sit on your hands and you let the winner do its thing. But here's the flip side. While you need to be patient with your winners, you have to be absolutely ruthless with your losers. This says it all. The moment a trade moves against you and hits your stop loss, that's when you get fearful. And that fear is the trigger for immediate action. You get out, no hesitation.
And this brings us to the absolute core of the entire blueprint. You can have the best technical rules in the entire world, but without the right mindset, none of it matters. This section is all about winning the psychological game.
This is the mantra that holds the entire system together. The market will be volatile, there's going to be unexpected news, panic is the enemy of a good decision, and your process, well, that's the antidote. Trusting the system you've built is absolutely everything. And this is the ultimate goal, isn't it? To execute your trades like a detached operator, not a gambler. The rules are there to do all the heavy lifting and decision-making for you, leaving you free to act with a clear mind when it really matters. Maintaining this mindset requires ongoing habits. This trader lists a few crucial ones: journaling every single trade to learn from your wins and your losses,
keeping the number of stocks you're watching small and manageable, focusing on quality over quantity, and resisting that constant urge to check and micromanage your positions. And this brings us to the final, and you could argue the most important part of the blueprint, defense. These are the rules designed for one purpose, and one purpose only, to protect your capital so you can stay in the game long enough to actually win.
Here's another hard number, 3%. This is the maximum monthly loss allowed. If your account drops by this much in a month, the system dictates a hard stop. All trading just stops for 15 days. It's a mandatory cool-off and reassessment period.
And here's another really powerful circuit breaker. It's not just about the total amount you lose, it's also about how often you're losing. 4 trades in a row hitting their stop-loss triggers a mandatory 1-week break from trading. This is designed to interrupt a losing streak before it can do some serious psychological or financial damage.
And finally, a rule that's all about accountability. This system is personal. The rule to never copy others isn't about secrecy, it's about ownership. You can't follow a process with real conviction if it isn't truly yours, because when the pressure is on, you simply won't trust it.
So we've walked through a really detailed plan for preparation, for execution, and for risk management. It's one person's attempt to impose order on the market. And that leaves us with one final thought. This is their blueprint. What rules and processes are in yours?